Good afternoon. Thank you for joining us today. This is our Navigating the Home Buying Process webinar with an emphasis on how to obtain a home loan. I'm Corby Gage, the Executive Director of Coastal Housing Partnership, and with us today is also Kim Pascage, who is the Program Manager for Coastal Housing Partnership. And today's webinar features three local loan officers, Jeff Boxler with Guaranteed Rate, and Veronica Chavez with PB and Associates, and Gabriela Santana from Guild Mortgage. So thank you so much for being here. It's a delight to have you join us, and appreciate you providing your expertise with us today. Jeff, Veronica, and Gabriela are all part of Coastal Housing Partnership's network. And as part of this network, that means that these lenders reduce their closing costs for their clients who are employed by Coastal Housing Partnership member companies. So that's you. The format for today's webinar is I will be asking Gabriela, Jeff, and Veronica questions about the process of obtaining a home loan and getting ready to purchase a home. The remainder of our time together will be to get your questions answered, and we think that's really important, so we encourage you to ask questions. We're going to be recording today's webinar, and so we'll send you a link to the recording after the session. The webinar format is a little different from a Zoom meeting. The webinar format means that your cameras are off and your microphones are off. So we can't hear you, and if you raise your hand, we can't call on you. So if you do have questions, please put them in the Q&A. You can ask them anonymously if you like. And so feel free to put those questions in at any time during the webinar. Just put them in when they come to you, and we will get that to them after we go through the questions that have been assigned to our three loan officers. So since the first step in the home buying process is to meet with a lender to find out how much of a loan you can afford, the information you're going to receive today will make you much better prepared to take that important first step on your path to home ownership. So let's get started. Jeff, would you please introduce yourself?
Yeah, thanks so much, Corby, and hello to all. Wherever you're at in the journey, hopefully today we just really give you some good insights. I have been in the industry for 19 years helping people with loans. So I've seen a lot, and I love all these questions that Corby's going to be asking of us today. They are really the most relevant, most often questions we get. So thanks for having me, and looking forward to helping y'all out. I'm based out of Santa Barbara, so that's my location.
Thanks, Jeff. Gabriela, would you share a little bit about yourself?
Sure. Thank you, Corby. Welcome, everybody. Thank you for having us, and looking forward to being able to give you some information. My name is Gabriela Santana. I work with Guild Mortgage. I've been in the mortgage industry for 22 years. Started in the Santa Barbara County. Now I'm in Ventura. And just as Jeff, I got to ditto what he said. These are great questions, great opportunity to ask questions in a neutral setting. You know, we're here to give you the information that you want. So take advantage, really pick our brains, whatever you have had in mind, just ask the questions, and we're here to help. You have three of us. So you got a lot of knowledge here.
Great. Thanks, Gabriela. Veronica, would you introduce yourself?
My name is Veronica Chavez. I am a loan officer with PB and Associates. I've had my license for 10 years, and the best thing that I can think of is what I love about this job is just when we get to fund the loan and get, the client into their home. So we're here to answer all your questions today.
Great. Thanks, Veronica. And that's what I think is really important as you think about your relationship with a loan officer, is that they're your partner in this transaction, and they're going to support you, help you. There's no question that you can ask that is too simple. They want to make sure you have all the knowledge, information, that you need to get started on this path. So really think of your lender in that way, as that partner and someone that you can go to with any questions, and they're going to give you a lot of great information. So that's the relationship that you want to have. So Veronica, we're going to start with you. Question we always get asked is, when is the right time for a potential home buyer to go meet with a lender? Do they need to be ready to buy right away, or is it a good idea to meet with a lender just to develop a game plan?
That's a really good question. And the best time to meet with a lender is the minute that it pops in your head that you are even thinking about purchasing a home. You want to meet with the lender. That way you can see where you're at. You want to see where you're at with your income, with your credit. And that way, if you're not ready at that time, you'll get set up and have a plan. That way you can get your home, because you have them first. So that way, when you meet with the loan officer, then you'll know exactly when you'll be ready.
So you're saying that even if you think you're ready to buy maybe 3 years down the road, you're waiting for a promotion, or you're going to have a partner who's going to bring in some income with you, you should still meet with the lender now?
Yes, you should really get in to see a lender as soon as possible, because that way you have a plan set up and you'll know exactly where you're at. Some clients think, oh, well, no one ever told me I couldn't purchase without 20% down. And, there's a lot of myths out there. So it's really good to go in with your loan officer right away. And that way you'll know exactly where you're at, because you never know, you might be ready now.
Sooner than you think, maybe. That's great. Okay. Well, so when you're talking to a lender, I assume you're asking them to give you a pre-approval. So what is a pre-approval? Why is it important, and what's involved in that process?
So pre-approval is when you go in to see your loan officer, and you're going to want to take your documents. Most of the time, they're all about the same. You would need 2 years of your W-2s, taxes, your ID. You'll need your income documentation, 1 month of your pay stubs, and then 2 months of your bank statements. They will run credit. That way we can find out if there's anything on your credit we didn't know about. And I know credit part of the
Veronica, you're cutting out a little bit.
application. We will find out, how long you've been on the job. We're gonna You're gonna want to know about how long you've been on the job.
Yeah,
Can
that's
you hear me
better.
now,
Yeah, you were
Corby?
cutting out a little bit. I just wanted to make sure we could hear everything you're saying. Great. You were saying that you'd
Sorry
be running
about
the credit and you'd be verifying the income.
And so running that way we can know exactly where you're at. Then with pulling the credit, we can tell you what amount that you'll be able to go start looking for a house for, or if there's anything that for future planning to be able to get you set up.
Okay, so it sounds like you're looking at credit, income, and assets, and those are the things that you're
Yes.
going to evaluate in that pre-approval process.
Yes.
Okay, and is then once you've done that, you're going to let the buyer know what their loan amount would be on a monthly basis and other costs around associated with a home ownership?
Yes, you'll be giving a loan estimate. On the loan estimate, it's going to be showing how much you qualify for, what the costs are as far as when you're purchasing a home. You have escrow and title fees. You'll know pretty much what you're going to be needing for the amount to close.
Okay, so your lender's going to give you all that information. So it sounds like that's a really great first step, because you're knowing exactly what your monthly payments would be, and therefore you're going to know the price range of your home. in that way, you know exactly what to look for. You're really focused and targeted in your home buying search. What a great, important first step. Is there something that in terms of when someone's making an offer on a home, should they be presenting their pre-approval letter? Is that helpful in terms of negotiating?
Yes, that is very helpful because when you're putting in an offer, the realtor also is going to know how much you're qualified for. That's going to help you to have a stronger offer when you put it in. Mhm.
Okay, great. Veronica, you are cutting out a little bit. I wonder if you might go out and come back in so that when you come for your next question, we have a little
Okay.
stronger
All right.
connection. If you
I
don't
will do.
mind, that would be great. I think we got most of what you were saying. If you wouldn't mind doing that, that'd be great. So that
Okay.
pre-approval sounds like a really important first step. There's no charge to get a pre-approval. So it takes a little
Yeah.
bit of time, but lenders are definitely interested in offering that service to you, and you realize that it's just a really good first step to take. Okay, thanks so much, Veronica. So
Thank
Gabriela,
you, Corby.
Veronica was talking about credit scores and that she's as part of the pre-approval, they're going to run your credit score, how important that is. Let's talk a little bit about credit scores. People always have questions on that. And so why is the credit score so important? Why is that always something that's so tied together with that loan approval?
Well, if we think about it, purchasing a home and having a home loan is generally one of the largest financial responsibilities an individual will have. You know, it's usually the largest debt that someone will have on their credit. So, this is one of the reasons why, when we're analyzing, like Veronica mentioned, the credit history, the credit habits, we can start seeing habits. It's an important factor because it's going to help us dictate what route we're going to take. So when you're sitting in front of that loan officer, like Veronica mentioned, and we're looking at the history, we're looking at what, not just credit scores, we are looking at activity, like meaning history, types of accounts that you have. This will help us dictate what route we're going, like I mentioned. So if we're going to be going with, like, say, a program that has the best interest rate, maybe a little conservative, but it's going to give you the best payment, or if we're going to have to go with something that's a little bit more flexible on credit scores, a little bit more flexible on credit history, but can't come with a little bit of a higher interest rate and higher payment. So it's important because it will definitely take us on the route to your qualification.
Great. Okay. So credit scores are sometimes a bit of a mystery. How are they determined, and what affects your credit score?
Well, the crazy thing about credit is that it changes frequently. We are a number, unfortunately, that's the truth of the matter, but it does change a lot. Our daily activities actually impact or shift our scores, if you can believe it. When we purchase gas, food, go shopping, and use our credit cards, or when we even pay our monthly bills. If we fall behind on any, say, utility bills or medical bills or even copays, without even knowing, this can be impacting our credit scores. So in addition to that, when we go shopping or we're at the store, at the mall or whatever, and we accept those, get 10% off your purchase today for applying for our credit card. So those deals definitely start impacting our credit scores, because too many inquiries, that's, when you're inquiring for debt or a card, start impacting you negatively, because they do stay on your credit report for 12 months. So when we see a lot of those on the credit report, we can kind of see that that's kind of impacting them. And it actually lets us know on the report how it's affecting them. In addition to that, the balances on our credit cards is a big factor. I got to say, that's a biggie, because that can start either helping us for a positive or shifting to a negative impact on our scores. If our credit card balances are more than 40% and continue that way for a few months, then this will start lowering our scores. So for example, let's say I have a credit card that's $1,000, just to make it easy. If my balance is over $400 and it stays steady over 405, 6, kind of up and down through the next few months, that account itself is going to start impacting me negatively on my credit scores. So it doesn't mean that we can't have balances. It just means we need to maintain them well for that account to be positive for the future. So this is where, when Veronica was mentioning having that discovery session with your lender is a huge help, because it's going to save you so much time. It's going to save you so much energy, and most of all, money. If you're trying to reduce debt, reduce costs, it's really important to have a path to try to get to where you want to be.
Okay, so that's interesting. So having a credit limit doesn't mean we should be using it. We shouldn't look at it that way. You're saying basically maybe 30%, 20, 30% of that would be a better number in terms of what we should be maintaining on our each of our credit cards.
Yes. Yeah. Like if you feel that your credit card balances right now are high, a good goal is to take steps, like targeting. There's different methods of doing it, but that's why really having that discovery session, you want to target what and save time on what accounts are really impacting you. Okay.
Now, Veronica mentioned that you'd be running your credit score when you go get your pre-approval. You were mentioning that you shouldn't have your credit run that'll have a negative impact. Is that still the case with running your credit score for a mortgage loan?
Well, a mortgage loan is, when we pull your credit, it's called a tri-merge. It's all three bureaus, Experian, TransUnion, and Equifax. Now it does impact you a little bit differently. The inquiries that I mentioned before, it's the total that you're having in a short period of time. So they do stay on your credit for 12 months. However, the impact is, like, for example, if I run your credit today, how many times they run your credit in a short period of time. If possible, if your lender can pull what's called a soft pull to get started, that would be ideal. So a soft pull is a credit report that provides all the information. However, it's not an inquiry. It's only used for that, for information. So that's ideal if it's doable with your lender, because for lending purposes, we do have some guidelines to follow, right? All loan programs do have some type of minimum scores to follow. So that's why we do need to have an idea of where you're at. If you do a credit monitoring service, that can be helpful for us, but they're not really exact. So if a soft pull is doable, then that's awesome. That would be great, ideal. But eventually you would have to have your credit pulled.
Now, you mentioned the minimum score for a loan. Is there a minimum score? Does that vary across loan programs, or?
Yes, exactly. So all loan programs have guidelines for credit score minimums, and they can range. Some can be from 580 all the way to 740. So it's a big range. But in any type of program, even in any type of financing, if we think about it, from credit card loans, auto loans, student loans, home loans, it's all based on the risk factor, right? So if we have a lower credit score, then we're considered a higher risk. So we really want to try to start at that, looking into things early on, just like Veronica mentioned. That's why that initial step when you're interested is important, because if you have good habits, you want to continue the habits. That's great. Just keep on doing what you're doing. But if there's something that you can adjust slightly, and it could be very small things, then it's nice to start early on, so that way you can continue those good habits through the process of shopping, through the process of buying. It's really important that when you're shopping for a home, talk to your lender. If you have any need to purchase, trade in, anything significant, it's really important, because keep in mind, we are basing this on your credit. So if something changes in the process while you're shopping or you're in the loan, say like you decide to buy a car, that's a biggie. We'll find out. Unfortunately, we do. So so just let us know, be open to us. Let us know where you're at, what's happening. Start paying attention to your accounts, maybe even putting them on auto pay if you need to at some point in time, just to keep that good record that you've worked so hard for.
This is such a big topic. Gabriela, I kind of have one final question on this, though. Is there something that someone should do to improve their score or to establish credit? Or is that something they might want to wait until they talk to a lender to take those steps? What would you advise there?
So, yes, meeting with the lender is definitely a big step. I think that would be very helpful. If you're really new to credit and barely establishing, there is some methods that can get you started, which is some of them, you've probably heard of the self-reported utility accounts. Those are now something available through the credit bureaus where you can tie your utility payments, which we make every month, like water, electric, gas, to our credit report, and it actually gives us credit. So what's important is that you pay those on time because then now they're going to be reflecting as a self-reported account. Another way to establish credit in a short period of time, and this is something you do want to consult your loan officer with because you want suggestions. However, if you become a authorized user on a well-established, well-maintained, I'm going to say that again, well-established and well-maintained credit card account, that will help you establish credit. But if you're looking into improving your credit, then that discovery session with the lender is going to be really helpful because it's going to save you so much time, so much money, because you don't want to be paying things that you don't need to necessarily. Also, it's really important to know that to establish credit, I forgot to mention, it's important to know that you don't have to get into debt. You just have to start using small debt in a positive way. So that, again, if you feel that you need guidance on that, definitely talk to your lender, definitely, because there is ways and methods to try to start like a kickstart on your credit when you're starting out. And you want to do it in good steps to get those scores up when they start establishing. So since credit changes so frequently, we do want to make sure that our activities, even daily, like I mentioned at the beginning, our daily activities, maybe if we need to start making small adjustments, things like that, this can happen in a short time frame if you're trying to improve. Don't ever worry that your credit scores or your debt is going to stop you from your path to homeownership. It's just creating that plan.
Great. Well, that's some wonderful information, Gabriela. And it sounds like one of the biggest takeaways I'm getting is that don't really do anything to try to improve your score without talking to a lender first. I think that the lender is going to be able to advise you. That's what you guys do all day long, is look at credit reports, credit scores, and you're going to be able to identify the thing that could help someone improve their score. So Veronica, so many people are asking, because a number of our employees that we work with are first-time home buyers. So they're saying, are there first-time home buyer programs available out there? Who's considered a first-time home buyer? I mean, is this something that someone should explore, and what should they know about this?
Okay. Well, I would say the first thing is a first-time home buyer is someone who has not purchased a home within the last 3 years and that does not currently own a home. There are first-time home buyer programs. A lot of them are county to county. So depending where you live, there may be a special grant that can pertain to your area. There's also first-time home buyer financing that we do have available. They are income restricted. So I can't express enough is to get in with a lender, because depending on what your whole scenario is, that your loan officer will be able to guide you in the right direction as to what a down payment well, first time home buyer programs there are that you'll fit into.
Okay, so someone doesn't really need to go and do all that research on their own. They're just going to talk to the
No.
lender and say,
Yeah, the
what's
lender
available
will
to me?
guide you. Yeah,
Oh,
yeah. That's what's great about going with your loan officer. We help out tremendously in any way that we can, to look into different programs that may fit you, your certain scenario, and what we can help, you do to for other programs that may be available. Mhm.
I think that's what's important, Veronica, about just this conversation that we're having is that
Yeah,
knowing that you don't need to know everything. You don't need to have everything
right.
buttoned up before you go to see a lender. I mean, that's what you're going to do for us as potential
Yes,
homeowners.
yes, that's what we're here for. We'll answer all your questions and guide you.
Okay. And it's kind of my understanding that some of these first-time homebuyer programs, even though they're income restricted, the
Mhm.
incomes are maybe fairly generous. They're not
Yes.
always, you can only make 30,000 a year to get in. I mean, they're pretty generous in terms of qualifying for these.
Yes, there are. There are a couple of different programs that do allow you to go into a higher income bracket, which is very nice.
Okay. So that's another good reason to go see a lender and find out maybe there's something available that you didn't know about
Yeah.
that gets you in sooner than you think.
Mhm.
Great. Good. Well, that's something to remember to, identify that first time home buyer situation.
Mhm.
So Jeff, down payment, this is always a big topic. So often people think they have to wait till they've saved 20% down payment. Is that the case? Or, what's reality out there in terms of what someone is really needing in terms of a down payment and their options there?
Yeah, great question. This is probably the number one myth that we see come across our desk all the time, and why people don't reach out, like Gabriella and Veronica have been talking about early on, and getting that plan set in place, because they're like, there's no way. I mean, home prices to everyone feels like quite high right now, and to think about 20% down, it's the number one barrier to people getting into housing. So the good news about this all is 20% isn't the minimum down payment. There's plenty of minimum down payment options out there, depending on where you're coming from. So, and what you're buying. So if you're a veteran, for instance, you can get away with as little as 0% down. FHA loans allow for 3.5% down, and they also come with a potential where you can get a grant or a loan to go along with it called a CalHAFA down payment assistance. So that can help you with even the 3.5% down in some situations. There's been the Dream for All program that the state of California rolled out and was gone in 12 days. So it
Jeff, you just froze.
on your situation, it's like each of the ladies have been saying, there might be very good avenues that are great interest rates and good options and low mortgage insurance options, that you don't have to come up with 20% down to feel good about the plan you're creating with your family and for your family. We have a workforce housing program here in town as well. That's North County, Santa Barbara, South County, Santa Barbara. I know Veronica likely has some grant programs in Ventura as well. Is it Gabriella? Which one are you on? Gabriella, sorry, and Ventura. So we each are in that every day, and whatever loan officer you're talking to should be able to give you some insights on where you might be able to cut corners on the down payment. And just know that the less you put down, though, the more your monthly payment's going to be. So there's always that balance, right? Of the more money I put down, the less my payment for the life of that loan is going to be. And that's just a helpful thing. On the down payment front, that a lot of people aren't aware of, because you might say, well, I only have X number of dollars in my checking savings account. And they don't consider a couple other avenues where they might be able to pull funds from that might be smart, or it might not be. But again, it's worthy of being aware of, and worthy of a consideration is we can get 401, we can get loans from our 401ks up to 50% of what our 401k balance is. So if you have a $20,000 401k balance, you can take up to $10,000 as a loan. It's a loan to yourself, so you pay it back. The same goes for an IRA. Normally, if you're under retirement age, you can't pull out money from your IRA without penalty. You get up to $10,000 of penalty-free draw if it's your home purchase. So that's really helpful to be aware of. Other than that, gift funds from family might be something that I always encourage people. Why, again, Corby brought up like the 3 years or sooner or down the line. A lot of people have heard their parents saying they would love to help them with the purchase in some form. So coming to any of us or any other loan officer and getting just some numbers on paper to be able to go back to your family and say, here's what I'm seeing, what I'm being told. Like me as a parent, like, oh my goodness, my kid is being so proactive. This is amazing. I keep thinking they're 16 years old and they're actually 28 years old and like being proactive about buying a home. Like I was going to give them $5,000. Now I'm going to give them 10 just because I'm seeing them be motivated and be responsible and adult. So family member gift funds are helpful if like even the 3.5% are a struggle for you. And we see this a lot in Santa Barbara too, is gift of equity. So buying a house from family. So mom and dad, grandma and grandpa, etc., want to sell their house to you. They can gift the equity within the house to you as your down payment, for instance. So that could save you. So might be more than you were hoping for, Corby, or dive into any of that. That might be useful to.
No, so
many
helpful.
people.
So I'm wondering if someone doesn't have any down payment at all right now, and they don't think they're ready to buy right away, should they still come to see a loan officer just to find out what these
Yeah.
programs are and to have a new game plan?
So here's the probably biggest mistake, and I like a little side thing that I did for a while, and I'm not doing it anymore because COVID hit and things got busy. But one of my passions was I saw so many of my friends through their 20s look at, and this was 2004, 2005, 2006, 2007, when home prices were really expensive then. And a lot of people, a lot of my friends did not save for a home purchase because they thought they'd never be able to buy. Okay. And so they never set aside any money. They had no idea what it would take to buy. And then they got into their 30s, started partnering up with people and got some raises at their job, maybe got a big bonus, maybe worked for a tech firm that got stock units or whatever. And all of a sudden they're like, whoa, like, I either need to buy, want to buy, can't have the ability to buy, and they just kind of spent the last 10 years not doing anything about prepping for it that would have set them up in a much better way. And so I find that just sitting down with me, I was just talking to a couple yesterday, they doubled their savings rate just after sitting down with me. And it's just because you now have two people on the same page about something bigger, a bigger savings goal in their life, that really is like, hey, let's not go out to dinner tonight. Let's make food at home. And now you can transfer $20 or $50 or whatever to your savings account for that home. It just gives you that bigger reminder, bigger purpose of something that matters. We all know that, like, living in American society, like, there's people at Apple spending 8 hours a day trying to put their hand deeper into your pocket about how to get you to spend more money on apps, spend more money on whatever, the next iPhone, etc. If you don't have that bigger goal close enough in your mind, it's easy to keep spending that money. And I would say just nothing more. I find it really valuable for people's finances and budget to just be considering something bigger than a $500 or $1,000 purchase. Yeah, I think I could say for all of us on here, we're agnostic to whether you decide to ultimately buy a house. It doesn't cost any money to sit down with us, whether it's a phone call or in person. But we really find that people are better for it, and more clear about their finances and budget just by spending that half hour filling out the application, looking over all their financials, etc., just to get it ready. I think is very healthy, right?
That makes so much sense. Just having that clarity and a goal. When you're working toward a goal, it's so much easier to make that happen. And establishing that goal with a loan officer is really important because it's realistic instead of just kind of wondering, am I doing the right thing or not? You have very firm direction. So I think that's helpful.
And we can even give you like, hey, okay, you want to buy in 5 years, let's chunk this up and say, okay, let's aim for $200 a month, savings, and see how, and check in 6 months and see how you're doing. And does that feel okay? And that stuff's easy for us to do, and it's no sweat off our back. So
great. So valuable. Thanks for that good information, Jeff. So Gabriela, we've been talking a lot about, go to see a loan officer. It's important to, talk to a loan officer, find out, about establishing a game plan. Well, so how does someone choose a loan officer? What should they be looking for? And should someone choose by who has the best rates, or are there other factors? How do they go about this?
Well, that's a great question because I feel that all of us, and I'm sure all of us agree that we're not just here to get you qualified. We build relationships. I mean, just the example that Jeff gave of the savings. Obviously, we have to talk to you. We have to have a relationship with you to get to know you with. So when you're looking for someone, especially if you're a first-time buyer, I mean, yes, the company that you go to, the loan officer that you go to is pretty important because of the fact that you want to know that you're getting options. You want to know that when you're having those conversations, like Veronica mentioned, that there is options available with that lender, especially first-time buyer programs if you are a first-time buyer. So that's ideal. And it just takes conversations, right? So looking into benefit programs like the Coastal Housing Partnership, I think that's huge. It's a huge asset to look into resources like this, because you have a list of different lenders that anybody on that list is very pro education. I mean, we're here to help you get through the process. That's why we're on that list to help you out. But I always do recommend my potential clients or anybody who asks me, what do I look for, to do a quick little interview with your loan officer. Ask them questions, ask them things that you've had on your mind, maybe even programs, like what's available. And knowing that there is some reciprocation, there's some knowledge there, that's going to be a comfort level. Also, the loan officer isn't there just to qualify you. If you've noticed with everything that we've said from Veronica to Jeff, like I said, we established that relationship. We're actually there to give you information of the process of qualifying, maybe provide you resources and options, of course, of for those resources, like what is it specifically that you need to help you reach your goal. So I always recommend ask questions. Don't be afraid to ask questions through the process, at the beginning, at the end, in the middle. It doesn't matter. Just ask questions. It's really important that when you have that initial consultation, that you're not just going to turn in your documents. It shouldn't be that way. It should be a conversation. It should be something that you guys are talking about programs available, maybe how you qualify, why you would not qualify. That's a biggie too, because we want to guide you in the right direction, and you kind of want to know what not to do. And that's because that could be a big factor. So always keeping in mind that a loan officer is a team player. I mean, it takes a team really to get you to your goal of home ownership. And you want that loan officer to be a big asset in that team because they're helping you with probably one of the largest purchases and decisions that you're making, especially as a first-time buyer. So you really want to feel that comfort level that you can ask questions, that they are there for you, that even if they don't know, that they'll get back to you. You know, there's responses. So if you know, you meet someone that you feel that connection with, that's great. It's golden. I have to say that if you're getting that response from your loan officer, it's really important because we want, like Jeff said, it is all up to you. We want to, our aim and goal is to help you reach your goal. However, it's so rewarding, like Veronica said, when we see that first time buyer, you know, go through the process, close that loan, get those keys, jump up for joy. You know, it's tear inspiring and it's emotional for us too. I mean, I've been doing it for 22 years and I still get emotional about my first time buyers. So building relationships. I think we're all in the business of building relationships. We're not just here to provide a loan. And you want to build that relationship, not just with your loan officer, with your realtor. And I know that you guys have webinars on realtors, but that we're a team. We work together and you want to know that we're all working in your behalf to get you the best thing that you can get.
So choosing the right home buying team is so important.
Yes.
Right. Thank you. Jeff, the lending market, you know, there's a lot of conversation about it these days. So how has the lending market changed? And, you know, we're dealing with higher interest rates. Are there ways to mitigate the impact of those rates? Should someone be discouraged about buying, or should they still proceed in terms of finding out what makes sense for them? What's your advice there?
Yeah, so what we've been seeing is and internally talking to like our head of capital markets, which means the people that are pricing our loans for us and talking directly to Fannie Mae and Freddie Mac, who do the large majority of loans across the country, is the government really has a big hand in housing, and they have a big leaning toward helping first-time home buyers right now, more than they have in many years. So how that looks like and how it plays out to you looking to buy is debt ratios. So if you have higher debts to your income, they're allowing more flexibility on how much debt you can have versus your overall income. FHA loans, for instance, you can have 47% debt versus income. A lot of my clients, and I would say it's probably for most, don't feel comfortable going that high. So if you have a $10,000, like say salary, you're making $120,000 a year, you can spend up to $4,700 per month. That's 47% on housing debts. Okay, so for FHA, that would be for a conforming loan or a jumbo loan. In some instances, you can go up to 50%. So that'd be $5,000 per month in overall debts. Slightly different. FHA is housing is 4,700 for housing. Jumbo and conforming is for overall. You've got underwriting guidelines that I feel like in some ways are getting more restrictive because of the housing market where it's at, and in other ways it's becoming more expansive. So if you're a self-employed borrower, they're more expansive right now. You could just show your bank statements instead of showing your tax return. So that I have a client, for instance, that was making $180,000 a year based on how they wrote things off on their tax returns. Well, we were able to show based on bank statements that they're making over $1 million a year in their bank statements. So that's a huge difference in what you could qualify for of $180,000 a year versus over $1 million. So I think that goes to show for a lot of non-bank lenders, like the three of us here, we have access to broker partners that want to get into different parts of qualifying that the big banks. So I know one of the questions on here, was a big bank. Big banks have their restrictive guidelines. They want to be pretty conservative most of the time. And they won't look at things that way for self-employed. So self-employed can be one of those reasons that you might look outside, more creative. And like Gabriella was saying near the beginning of this conversation, like we're always trying to help people with the center of the bullseye, because that's going to get you the best interest rates and the best terms, costs, etc. But there are avenues, bridge loans, for instance, if you need to sell your house before buying. There's 2-1 buy downs to help you with a lower interest rate for the next 2 years. You're going to have a rate that's 2% lower, and then 1% lower, and then back to like the going interest rate. So that's to help people with having a lower payment for the year one and slowly ramp up to that. That wasn't available, I'd say, a year or two ago.
But you're saying, Jeff, that you're not necessarily stuck with interest rates where they are now. You do something that makes it your interest rates lower than the market, right?
Yeah. So that how that works, it's a fun thing to be aware of, is like you're having to still get the seller to credit you to cover that, and essentially they're participating in your payment being lower for the first year and the second year, and you could get it up to 3 years of lower payments. And you could refinance in year 1 or 2 if rates come down. So yeah, there's ways that everyone's trying to solve this problem of rates are abnormally high right now. Rates are expected to be lower by end of 2024, end of 2025. So how do we bridge that gap? A lot of the loans, though, would say if you're looking to buy right away, a lot of the loans that I'm seeing are coming with points. So buying down the interest rate, just traditionally, you can lower your interest rate by paying extra up front. And the trade you're making is, I'll pay this extra up front and I'm going to get a lower payment for the life of my loan going forward. Okay, so normally paying points takes 3 or 4 years to make back that trade. Okay, and if you have that loan for 4 years, you're making the trade, and the trade is winning for you financially. Right now, it's oftentimes like 2 years to make back that money. So it usually makes sense to pay points, or it's very tempting to, because the bets right now are that rates will be lower in the next 2.5 years, and you hopefully can refinance by then. So it's yeah, I don't want to get too into the weeds on that, but just the whole goal of today hopefully is just to keep planting a bunch of seeds for you and say, oh, I heard about that, I should bring that up to Gabriella, I should bring that up to Veronica or Jeff, so we could talk more concretely about your situation.
So the lender would run you numbers both ways, showing you what it would be paying points and what it would be without paying points, so you could get a sense of whether that makes sense for you.
Yeah, and I'd say the 3 kind of samples that I would always just want to see if I were a borrower is whatever target down payment you have for yourself. So let's say it's 5% down. Do 5% down with 0 points and 1 point cost. See how much lower that gets your rate, or close enough. Ask your loan officer to give you like what seems to make most sense, because there's usually a sweet spot. And then ask for like a 10% down option, even if you don't think you can do 10%, just to get an idea of like how that extra little bit of money or a lot of money, depending on the scenario, might impact you positively. Or you say, hey, it's really not that much monthly savings. Like I feel good about 5% down, you know? So I think
Great.
today I was looking at 5% down versus 10% was like $250 a month difference. And for some people, and it was like $30,000 more out of pocket. So some people might say, hey, I'd rather just pay the extra money per month. I'd rather keep the 30,000 to do some work on the house, or I don't want to wait 2 years till I have the extra 30 grand.
Another good reason to go see a loan officer.
Yeah.
If there's one takeaway from this, it is make that step, take that step to go see a loan officer. So Kim,
Mhm.
it looks like you've got a number of questions from our attendees. What are you
Yes.
seeing?
Yes, we have some questions, and again, feel free to keep adding questions to the Q&A here. So the first question is, will running a credit check at pre-approval count as a hard inquiry?
Veronica, you want to talk about that pre-approval and what happens when they're running the credit check? Is there an impact there?
Okay, so there is, as Gabriela had stated, there is a soft pull and there is a hard inquiry. Your loan officer should be able to do both, but usually when you're going in and you're not quite ready to purchase, a soft pull is great, and it still will show us what your debts are and if there's anything that needs to be worked on so that we can help you.
Great. So definitely ask the lender, is this going to be a soft pull or a hard inquiry? Okay.
Yes.
Great. Thank you.
Yeah, and then Jeff, I think you talked a little bit about this, but the pros and cons of choosing between a private or bank lender.
Yeah, so I've worked for both. The banks are very clear cut on what they can offer, and if you don't fit that, they can't help you. Why I think all of us work outside the banking world is it allows us to solve more problems. And so that would be one of the things that would differentiate us between big banks. But if you fit the guidelines of the bank, then it's more who do you like working with, who seems to be more responsive to you, helpful to you, maybe blend of that plus rates. Who do you want to call when ultimately you're stressed out dealing with a home purchase, like will they text you back? Will they call you back after hours, weekends, etc.? That's one of the things that just be aware of that. Like that would be one of my things I'd be trying to feel out is who do I really feel like the bat phone is there for me, because it will be stressful. And that doesn't matter whether you're a bank or not. But just clarify.
And that often comes down to just the loan officer.
You got it. You got it.
Okay, great.
Yeah, this next question has a couple of things in here, but it says, do lenders care if I use all my savings for the down payment? Do they expect me to keep something in my savings? Do I need a certain income? For example, with rent, I have to make 3 times the monthly rent. What's the rule of thumb for mortgage? And is there an income restriction to use coastal housing benefits? So there is no income restriction for our program, to clarify that point, but wanted to,
Okay, yeah, and as Kim mentioned, no income restrictions on coastal housing partnership programs. It's not first-time home buyer only. So any employee of a member company can use the coastal housing partnership benefits, which save you money through the lender. They waive parts of the closing costs, as well as the real estate agent will give a commission credit, and the home inspection company will offer a savings. So usually we can save you 50% or more on your closing costs. So definitely explore that. Reach out to Kim or me to find out more about that, and we'd like to help you in that way. Jeff, do you want to take that other part of the question?
Yeah, so in regards to reserves, what we call reserves, money left over after down payment, you definitely would want to have usually minimum 2 months. There's some programs that require 0 months of reserves left over. And then on upward on jumbo loans, it can be 6 months, it could be 9 months, it could be 12 months, depending on the program. And that's of your housing payment with taxes, insurance, mortgage insurance, whatever, HOA dues included. That would be how we multiply that out. So 0 to 12 months, I would say, depending, and that's again why you'd want to talk to a loan officer. Know that 401k or an IRA that satisfies those reserve requirements, though we take them at 60% of the value. So just it can be helpful to know that your retirement funds can be used for reserves. They don't need to all be in cash.
I think what's important to know too is this is not a formula across all people. Everyone's financial situation and what they're bringing to the table in terms of this approval is going to be different. So someone may have more down payment. That may mean, less reserves, or, whatever it is, whatever the trade-offs are going to be. That's what your lender is going to help you do. So there's not something that you need to come into to see the lender with, I have all of these boxes checked. Let them tell you what boxes you need to check based on what your financial picture looks like and what you're bringing to the table. Okay, Kim?
Yeah. The next question is, if a home buyer has 20% down payment available, what can they do to decrease the home loan interest rates? Can they buy down the interest rates?
Now, Jeff kind of covered a bit of this. Gabriella, do you want to add anything to that?
Yes, exactly what Jeff was mentioning. There is options to reduce your interest rate, either a temporary buy down or a permanent buy down. So the main difference is a permanent buy down is you're buying those points, what they're called, right? And points are based on what the rates are that day. So you do want to at least get an idea of what you're looking at when you're actually in the process of purchasing. Usually if you've had that conversation with your loan officer, then that's kind of one of the first things we're going to talk about, right? When you make that offer, get into contract, we start having that conversation to show you the differences, exactly like what Jeff mentioned. We're going to show you what it is with points, what that interest rate looks like, what the payment looks like, and then without points, so that way you can see if it really pays off. And we can even do the math for you to see what really, is it a good deal that you're doing. Now, the temporary buy downs, those are when you're, just like it mentions, you're temporarily purchase or buying down your interest rate. So the most common that people go with is a 2-1 buy down, which means that you're technically paying up front for the portion of the interest of those 2 years. And for the first year, your interest rate will be 2 points less. So let's just say, for an example,
Can I pause you
7%.
real quick, Gabriella? Because I see a question. Can you say what points actually mean when you're talking about points?
Okay, so
Yeah.
a point is it's a cost. So for example, let's say the interest rate is 7% today. So a point is where we pay, or in this case, 1%. So 1 point is 1% of the loan amount. So if your loan amount is $500,000, then 1 point would be $5,000. So like I mentioned before, the points vary on a daily basis. So depending on what you're aiming for, sometimes it is definitely worth it. So paying that $5,000 in that scenario can get you a lower interest rate. It's not like rate for point. Sometimes in our minds, we might think it's like one for the other, or 1 point equals 1 point in interest rate. It's literally based on that day's rates. So that's why it's important to have those conversations and see those estimates from your loan officer, so that way you can see, is it a good deal? And you can do more than one. I've seen people have used part of that down payment money to reduce their interest rate because they rather have that lower interest rate moving forward than you choosing to put it all towards their down payment. So the temporary buy down is not buying points. You're actually buying down you're paying up front for interest. If you do a 2-1, it's 2 years. So your interest rate would be lower for the first 2 years, 2% lower for the first year. Then it would go to 1% higher for the next year. And then on the third year, you're at your permanent rate. So it is helpful to get you started, especially to kind of get that payment shock of stepping into something higher. Definitely. It is something to think about as far as the investment to it as well. It's another option to have on your side when you're looking into, okay, what is going to be our initial investment in here, and what is going to be our monthly payment. So those are,
Great.
it's a very good option, actually.
Okay, thank you, Gabriella. Looks like a couple more questions, Kim. I know we're at time, but if
Yeah.
anyone can stay
Actually,
on with us, we'll keep going.
Yeah, last one, if you own a house and want to change it for a different house, can you keep the current interest rate?
Veronica, do you want to take that?
Hi. Okay, so when you're selling your home and you want to purchase another one, was that the question? When you want to,
But you're keeping the first house? Is that what
They're wanting to see if they can transfer the loan rate
Oh.
over to the new house.
Okay, all right, so transferring that.
So you're
The loan on the
selling and buying a new house and hoping to keep that same loan.
yeah, that you would have to apply for a whole new loan unless there's something, Jeff. But I haven't
Yeah.
seen anything out there that will let you transfer it, but you would have to be applying for the whole new loan for the new home.
Yeah,
But if you
So
wanted
there's
to
no-
keep that, if you wanted to keep that first home, and then buy a different home and keep that first home as an investment property, you could keep the loan on that home, definitely. But you'd have to
yeah,
get a new
that's a
loan.
very good point, Corby.
Yeah.
You could get a renter in the place you're departing, but you
Mhm.
would still be beholden to the current rates of today for the new purchase.
Mhm.
So you do see that would be go a little off course. I'm not assuming too many people are here, but in regard to this, but a lot of people want to buy their first house and then eventually turn that into a rental property, right?
Mhm.
And so you have to live in that first house for a year to claim it was a primary. That's the plan. That's the intent. You don't have to, but that's the intent if you're getting a primary residence. And then you can leave that rate, leave that home, rent it out, and buy a new one as your primary. If this is something that you want to slowly start to acquire more and more property.
Great. Is it on the questions, Kim, or did something else? just come
Yeah,
up?
I also put in the chat the link to our home buying fair, which is coming up in October. So you can RSVP and look at our seminar schedule. It's going to be a great event on Saturday, October 28th.
Yes, in Santa Maria at the Radisson, and we provide lunch, and there will be seminars throughout the day, more chance to get education and meet Coastal Housing Partnership Network partners at their booths. And so we encourage you to come. It's a fun event, and it's free for the employees of Coastal Housing Partnership.
It's definitely worth going to. There's a lot to be learned.
Yep.
Yeah, all three of our lenders today have been exhibitors at the home buying fairs, and generally we find that people who have attended the fairs come away with a lot of good information and get right on that path to home ownership. So it's a really good first step for you. Encourage you to do that. So I want to thank our panelists, Jeff, Gabriella, Veronica. Thank you so much. This has been a great hour together and such great information, and I'm sure it's been helpful for our attendees. Thank you for sharing your expertise and your time. And thank you, attendees, for joining with us. Please reach out if you have any questions. As you can see, all of our panelists' contact information is here. Encourage you to reach out to them directly or to Kim or me. Thank you so much.
Thank you.
Thank you.
Have a great
Thank you.
one.
Okay.
And we will send out a recording. So